This wasn't a market move, it was a detonation. On January 20th, while cameras focused elsewhere, a contradiction ripped through the system. Prices looked calm, liquidity looked normal, but a single executive order quietly rewired what money even is. According to the document, silver was reclassified overnight as a strategic monetary metal tied to national security. That's a fact, and it instantly changed who controls it, how it's priced, and who's exposed. Here's why this matters to you. Your savings, your paycheck, your cost of living all sit on top of paper pricing. The order didn't target stocks or rates, it targeted the mechanism underneath them. Banks lost hundreds of billions in capitalization as paper ceilings stopped working. That's not volatility, that's structure failing. Now notice the detail most people missed. Vaults weren't audited by regulators. They were audited by the Defense Department, not accountants, not civilian agencies. That signals something very different. The document suggests this wasn't a reaction, it was preparation. And if that's true, the obvious question is this: what did they see coming that required moving this fast? What happened next looks isolated at first, but it isn't. The executive order didn't arrive in a vacuum. It landed inside a system already stretched thin, already relying on assumptions that only work as long as nobody checks the math. Officially, the action was framed as a national security adjustment. Strategically, it did something far more disruptive. It removed silver from the category of just another commodity and placed it inside the same framework as defense assets. That shift alone altered how contracts, inventories, and obligations are treated. But here's the pattern. This wasn't the first time markets were told everything was fine while pressure built underneath. The order didn't explain every consequence. It didn't need to. It only needed to change the rules, and it did so using language that bypassed the usual financial circuit breakers. Now watch how this reframes the event. If silver is no longer just traded but strategically controlled, then paper promises tied to it stop behaving like money. They behave like liabilities. That's the pivot most coverage skipped. So ask yourself this: if the system was stable, why change the rules at all? And if it wasn't, how exposed was it already? The claim that matters most is simple. The system wasn't just fragile, it was mathematically trapped. According to the material, a small group of major global banks were carrying an enormous short position in silver, measured not in percentages but in hundreds of millions of ounces. That's the fact. These positions weren't backed by equivalent physical metal. They were backed by confidence that contracts could always be rolled, settled in cash, or suppressed through paper supply. That worked for years, until the rules changed. Here's the concrete problem. Available registered inventories were only a fraction of what was promised on paper. The imbalance wasn't minor. It was more than 10 claims for every single ounce that could actually be delivered. That means the system only functions if nobody asks for the metal. Now notice what's missing. There's no mechanism in the order that allows new short positions to be opened to defend the price. No pressure valve, no delay. Once prices begin to move, losses don't rise linearly. They accelerate. This is where the story flips. At higher prices, the losses don't threaten profits. They threaten solvency. Entire balance sheets collapse under exposure that was never meant to be tested. And if that math is real, then the next question isn't whether prices move. It's what happens when delivery is demanded and the metal simply isn't there. From there, escalation was no longer optional. It was automatic. Once the imbalance became visible, the situation began to resemble moments the system still pretends were exceptions. In past crises, leverage unraveled slowly. This time, it compressed into days. The difference is normalization. For decades, selling claims on metal that didn't exist was treated as routine. That behavior wasn't hidden. It was institutionalized. And it worked as long as confidence held. Now watch how fast that flips. As the paper price starts to disconnect from physical reality, the tools used to smooth volatility stop functioning. Liquidity doesn't disappear because people panic. It disappears because no one is willing to be the last seller of something they can't deliver. This is where something abnormal becomes routine in the opposite direction. Trading halts, delivery rules change, emergency language enters official statements. None of that is supposed to happen in a healthy market, yet here it is, treated as maintenance. But here's the part nobody says out loud. Once an exchange normalizes the idea that delivery is flexible, trust doesn't bend, it breaks. And when that happens, price discovery doesn't slow down, it relocates. And if the market that set the global price no longer functions, the obvious question becomes unavoidable: where does the real price move next? The second proof hits harder because it exposes a contradiction you can't unsee. Publicly, institutions insisted obligations would be met. Privately, actions told a different story. According to the material, major players began invoking force majeure on physical delivery. That's not a delay, that's an admission of inability. Customers who believed they owned metal were pushed into cash settlements at paper prices while the asset itself surged elsewhere. The words said stability, the action said default. Now focus on one detail: trading halts weren't triggered by wild speculation. They followed losses that exceeded entire equity bases. Positions once described as manageable suddenly dwarfed market capitalizations. That's not a trading error, that's structural exposure finally surfacing. Here's why that detail changes everything. A cash settlement only works if the price reflects reality. But once physical markets decouple, paper prices become placeholders. They calm headlines while value escapes. Notice what wasn't denied. No one disputed the size of the positions. No one confirmed the metal was there. Silence filled the gap where assurance should have been. At that moment, the story stops being about silver. It becomes about credibility. Because once delivery fails in one corner, every paper promise nearby is reevaluated. And when that reevaluation begins, it doesn't stay contained. From that point, pressure started stacking faster than explanations could keep up. First, liquidity facilities were announced, then exceptions were added, then legal language quietly limited who could be rescued and who could not. Each move was framed as stabilization, but together they formed a pattern of containment, not control. The system wasn't slowing the problem, it was boxing it in. At the same time, physical demand surged where delivery was mandatory. Markets that require real settlement didn't pause, they repriced, and that repricing pulled metal out of reach for anyone still relying on paper claims. Speed became the defining feature, contracts rolled off, margin calls hit, counterparties stopped answering phones. Now watch the loss of control. Measures designed for temporary stress were deployed against a structural shortage. That mismatch matters. You can lend liquidity, you can't lend metal that doesn't exist. This is where the mini-crisis becomes systemic. Each intervention creates a new pressure point somewhere else. Each delay tightens the squeeze. No single decision causes the break. The accumulation does. So ask the only question that matters now: what happens if this doesn't stop? Now shift the lens to where this actually lands, on you. When delivery becomes uncertain, the effects don't stay inside trading desks. They move outward into everyday life. Electronics, vehicles, energy systems, medical devices, all of them rely on steady access to materials priced through these markets. When contracts fail and supply tightens, manufacturers don't debate ideology. They scramble for availability. Here's the lived consequence. Companies abandon just-in-time inventory. Costs spike overnight. Production schedules slip. Those pressures don't show up as headlines about silver. They show up as higher prices, delayed products, layoffs, and canceled projects. Quietly at first, then all at once. Notice how fast responsibility shifts. Corporations pass costs forward. Governments deflect. Consumers absorb the difference. You don't get a warning label saying this price includes market failure, you just pay it. This isn't about speculation, it's about access. When physical supply becomes strategic, someone loses priority, and it's rarely the end user. If this feels familiar, say so in the comments, because recognition is the first sign this pattern isn't new, and once you see it, you start noticing how often it repeats. At this point, outrage doesn't explain what's happening. Incentives do. Systems like this persist because they reward behavior that works until it doesn't. Selling paper claims created liquidity, suppressed volatility, and generated predictable profits. As long as delivery was theoretical, leverage was invisible. Everyone benefited from the illusion of abundance. That wasn't a conspiracy, it was a structure. Now look at what breaks it. Mandatory physical settlement, strategic reclassification, removal of rescue mechanisms. Each change strips leverage of its hiding place. When the incentive shifts from rolling paper to securing metal, behavior flips instantly. Hoarding replaces hedging, access replaces price. Here's the unsettling insight. The system doesn't collapse when people act irresponsibly. It collapses when they act rationally under new rules. Once participants realize scarcity is real and enforceable, cooperation vanishes. This is why mainstream coverage feels incomplete. It focuses on reactions, not mechanisms. But mechanisms decide outcomes long before narratives catch up. And once a system reveals that it can't honor its own contracts, the next move isn't outrage, it's exit. The only uncertainty is how fast that exit spreads. There are two paths forming now, and neither is clean. In one direction, authorities attempt to stabilize the surface, temporary fixes, modified contracts, controlled pricing. The goal is to slow the repricing long enough to manage the fallout. That path depends on confidence holding just a little longer, even as reality moves elsewhere. In the other direction, the shift accelerates. Physical markets set the tone. Strategic buyers secure supply directly. Paper venues continue to exist, but as reference points, not sources of truth. In that scenario, prices don't spike because of panic. They reset because the old anchor is gone. Both paths carry risk. One risks a credibility break if containment fails. The other risks rapid adjustment that institutions aren't built to absorb. What decides between them isn't a press release. It's behavior. Who demands delivery? Who accepts substitutes? Who exits quietly? Here's the key uncertainty. The next move is already forming, but it won't be announced in advance. It will show up as a small decision that forces everyone else to react. And once that reaction starts, momentum, not policy, takes over. Here's the insight that ties all of this together. This story was never really about silver. It's about what happens when a system built on promises collides with a requirement for proof. For decades, value was defined by confidence and continuity. As long as contracts rolled and prices displayed, the system appeared stable. But stability based on assumption isn't resilience. It's delay. What changed wasn't greed or fear. It was verification. Once delivery mattered, leverage lost its camouflage. Paper didn't fail because it was fraudulent. It failed because it was optional. That's the reframe. Markets don't break when people stop believing. They break when belief is no longer enough. And once one asset forces that realization, others don't stay immune for long. This is why the ending isn't here. It's ahead. The next chapter isn't about prices. It's about which parts of the system are forced to prove themselves next. If you want to stay ahead of that curve, follow for continued analysis. Because the real story is just starting, and most people won't see it until it's already moved.